Welcome back, everybody. Patrick here, and moving on with the capital structure chapter, we're now going to be talking about the effects of financial leverage. And leverage is just another word for debt, right? So the more debt a company has on that right side of the balance sheet, the more leveraged we say that they are. And furthermore, we're going to discuss how leverage, how taking on more debt affects shareholder value. And more specifically, we're going to look at the specific measures of earnings per share and return on equity. All right, so this video is going to be the effects of financial leverage, or the effects of debt on earnings per share and return on equity. So now let's dig a little deeper and introduce a specific scenario. So we have a firm. They have a total market value of $175,000. They have no debt and 20,000 shares outstanding. In a normal economy, the earnings before interest and taxes is $30,000, and the earnings before interest and taxes will be 30% higher and 40% lower in an expansion and recession, respectively. So we are dealing with three different economic conditions. Now, let's show how this firm's balance sheet looks like on the side here. So we got the assets, we have the debt, and then we have the equity. Well, it says in the question that the firm has no debt. So it has no leverage. So the debt here is going to be $0. They also say that the total market value of the firm is $175,000, meaning that the value of the assets is $175,000. Well, if the assets are $175,000 and the debt is $0, then we know the equity has to be $175,000. Because both sides of the balance sheet has to balance, the left side and the right side. Now, furthermore, we're also told that there are 20,000 shares outstanding. So under this equity portion, we have a little bit more information. We know that there are 20,000 shares in the market. And those 20,000 shares, actually, let's write shares here just to not get confused. And we know that these 20,000 shares in total have a value of $175,000. Now, if you remember at the beginning of the video, we discussed how financial leverage is going to affect the return on equity and the earnings per share. So let's find out what the return on equity and the earnings per share are going to be for this firm. Notice how they have no leverage. But if we can find out what those measures are with this firm and then perhaps maybe leverage this firm after, we can see the effects that the leverage is going to have on those specific measures. Now, notice in this scenario, we're not given any information about the taxes that the firm pays. So we're actually going to do two scenarios. We're going to find the return on equity and the earnings per share, assuming that this firm pays no tax. And then after, we're going to do a scenario where the firm is paying a certain percentage of tax and see what the differences are. Now, return on equity and earnings per share, if you remember, are these respective formulas. So return on equity is net income over equity, and earnings per share is net income over the number of shares. Notice how both of these, we already have the denominators, but we need to find the net incomes. So what we have to do is we have to take the earnings before interest and taxes that we are given, and we have to work down on the income statement to get that net income. So notice how we're given three conditions for an economy: recession, a normal economy, and an expansion. And we're only given the earnings before interest and taxes for the normal economy of $30,000. So I wrote that here. That's the earnings before interest and taxes. But we're told that the earnings before interest and taxes will be 30% higher for an expansion. Okay, so if we take that 30,000 and multiply it by 1.3, right? 1 plus 30% in decimals, which would give us 1.3, that would give us 39,000. So that's going to be the earnings before interest and taxes for an expansion. What about a recession? Well, we're told that the earnings before interest and taxes is going to be 40% lower. So the way we do that is we take 30,000, and instead of doing 1 plus that rate of growth, we're going to do 1 minus the rate of decline, which would be 40%, which would be 0.4 in decimals. Right? So it'd be 30,000 times 0.6, which would give us 18,000. All right, so in a recession, our earnings before interest and taxes is going to be 18,000. 30,000 times 1 minus 0.4, which gives us 18,000. So 18,000 is 40% lower than 30,000. We just took 40% of 30,000 and subtracted it from 30,000 to get 18,000. And now that we have those figures, let's move down the income statement. So this is earnings before interest and taxes. So what's next? Well, we got to subtract the interest that the firm is paying. Well, interest is what? It's based on the debt that a firm has. And notice how this firm has $0 of debt, meaning that they are going to pay $0 of interest. And then what's next after interest? So earnings before interest and taxes, and now we are subtracting the interest. So we're left with what? Earnings before taxes now, right? So we just subtract these figures. Earnings before taxes, 18,000 minus 0 gives us just 18,000. 30,000 minus 0, 30,000, and then 39,000 here. So we have our earnings before taxes, and now what comes next? We have to subtract our taxes. Well, in this case, I said that first we're going to assume that the company is paying no taxes. So the tax rate is 0%, so no taxes, so this would be 0 as well. Right? So we subtract the taxes from the earnings before taxes, and then finally we get to the figure that we want, which is net income. So then the net income for all three respective economic conditions are going to be 18,000, 30,000, 39,000. So if you're dealing with a case where a company has no debt, so they are paying $0 worth of interest, and they're paying no taxes, the net income is always going to be equal to the earnings before interest and taxes. Now, one thing I want to mention here is whenever a company has no debt, has $0 worth of debt, another word you might see for a company like that or a firm like that is that they are unlevered. Right? So the opposite of leverage. So a leverage company has debt. We said at the beginning, leverage means that a company has debt. Well, if a company has no debt, it means that they are unlevered. So you may see this come up. Whenever you see this come up, it just means that an unlevered firm has $0 worth of debt. So getting back to our income statement, we have our net incomes, and now notice how we can figure out these ratios here, the return on equity and the earnings per share. So let's start with this return on equity here. So what we'll do for the recession scenario is we'll take the net income, 18,000, divided by the equity in dollar terms, which is 175,000. So 18,000 over 175,000, if you do that in your calculator, you would end up getting 0.1029 if you round. And if you convert that to percentages, we can express return on equity in percentages. That would be what? 10.29%. So that's going to be the return on equity for this firm in a recession. We just took the net income in a recession, divided it by the dollar amount of equity, 175,000. And if you do the same thing respectively for a normal economy and an expansion, you would get these return on equity figures. So this one, this 17.14%, we got by taking 30,000 of net income, dividing it by 175,000. Then expansion, 39,000 divided by 175,000 gives us 22.29%. So the denominator is always staying the same. The equity figure is always 175,000. The only thing that's changing is this net income, depending on which economic scenario we are in. So these are the return on equity figures. Now, a lot of times, questions may also ask you the percentage change of the return on equity from the normal economy, right? So using the normal economy as like a base, they'll ask you how much does the return on equity go up in an expansion? And if you remember, percentage change, what is the general formula? We've gone over it a couple of times. It's basically the new amount minus the old amount, or the base amount, all over the old amount, right? So if we want to know the percentage change of the return on equity when there's an expansion, well, we would take the new return on equity, which is 22.29%, subtract the base return on equity, which is 17.14, and then we divide that by that same base of 17.14. And in this case, when you do that, what you would get is 0.3, right? Or 30%. So the percentage change was that it's a 30% increase. And notice how this 30% increase is the same as the earnings before interest and taxes increase from 30,000 to 39,000. And that makes sense because if you remember, the return on equity, the denominator is not changing. The only thing that's changing is the numerator. Well, if we're increasing the numerator by 30%, that means that whole ratio is going to increase by 30% as well, right? And if we do the same thing on this side, if there's a recession, percentage change is what? The new return on equity, 10.29, minus 17.14, the old, which is the base, right? The return on equity in a normal economy, all over the base of 17.14. If you do that, you end up getting negative 0.4, right? Which is, this is in decimals, that's the same as a negative 40% or a 40% decrease. So this would be 40% decrease. Or sometimes they'll ask you to put 40% maybe in brackets, representing a negative number, right? And again, that 40% decrease is the same as the decrease of the earnings before interest and taxes when there is a recession, right? So just be aware of that. This percentage change, when they're asking for it for a specific ratio, you use the normal economy as the base, as that old figure in that general formula, and then your new figures are going to be either the return on equity in an expansion or the return on equity in a recession. All right, so we're done with return on equity. Let's maybe kind of isolate it from everything else, just so we're not getting confused with all these numbers. Now let's figure out what the earnings per share are going to be. And earnings per share is what? It's the net income over the number of shares. So let's start off with a recession. So the net income in a recession is 18,000, and the number of shares we're given is 20,000 shares for this firm. The equity has 20,000 shares, so that's what would go here. This would be 20,000. 18,000 divided by 20,000, that would give us 0.9. So each share is earning about 90 cents on the dollar, right? So we got that again by taking net income, dividing it by the number of shares. And if we follow that same pattern for a normal economy and an expansive economy, so net income 30,000 divided by the number of shares of 20,000 gives us 1.5. 39,000 divided by number of shares of 20,000 gives us 1.95. And again, these are the earnings per share numbers, and sometimes they'll also ask for the percentage change. So just like return on equity, you use the normal economy as like a base. Well, if there's an expansion, how much, by what percentage did the earnings per share increase? So to get that, you would take the new amount, 1.95, subtract the base amount, 1.5, all over 1.5. And if you do that, 1.95 minus 1.5 gives you 0.45. 0.45 divided by 1.5 gives you 0.3, positive 0.3. Meaning that there is a 30% increase. And same thing here, if you do 0.9 minus 1.5 divided by 1.5, you would get a 40% decrease. And notice how those numbers are again in line with that percentage change of the earnings before interest and taxes that we are working with in the question. Because again, the number of shares in the earnings per share formula, the denominator is constant at 20,000 and the net income is just changing by the same percentage that that earnings before interest and taxes is changing. Right? So these numbers in a no tax, no interest, or no tax and no debt situation, these percentage increases in the return on equity and the earnings per share should be the same as the percentage increases and decreases of the earnings before interest and taxes. So this is it. This is the no tax scenario for a unlevered firm, the return on equity, and the earnings per share. So now let's move on to a scenario where this same firm is going to pay 30% of taxes. Let's see what changes with the return on equity earnings per share. So we have to go back to our income statement and we have to get to that net income figure now. It's going to be different than the scenario before where this company paid no taxes. So earnings before interest and taxes are still those same figures here. What's the interest going to be? Well, notice that this firm still has $0 worth of debt. It's still unlevered, so the interest is going to be 0 for all three scenarios. So that means the earnings before taxes is going to be the same as the earnings before interest and taxes for all three scenarios as well. But now what's going to be different is the tax, because now we're paying 30% tax, right? Before it was 0, now we have to pay 30%. So to figure out the tax portion for a recession, we would take the earnings before taxes of $18,000 and then multiply it by 0.3. And if you do that, you get $5,400. So that is the amount of taxes that we have to pay in a recession. And then following the same pattern, 30,000 times 0.3 would give us $9,000 worth of taxes. And then with the 39,000 earnings before taxes, we would pay $11,700 worth of taxes. So then subtracting all these figures, 18,000 subtract 5,400, that would give us 12,600. So that would be the net income for this firm in a recession. This would be 21,000. And then 39,000 minus 11,700, that gives us 27,300. So all three of these are the three net income figures for all three respective economic scenarios. And notice how these net income figures are different than the scenario we went over before where the company pays no taxes, because now the company is paying 30% in taxes. So that net income is going to be different. And now that we have those net income figures, we're now just going to find the return on equity like we did before and the earnings per share. So let's start off with the return on equity. Return on equity is net income over the equity amount. So for a recession, we know our net income is $12,600. If we take 12,600 divided by 175,000, the equity is still the same. We would get 0.072 or 7.2%. Same thing with a normal economy. Take the net income, 21,000, divided by the equity of 175,000. We would end up with 12%. And then 27,300 net income divided by 175,000 worth of equity, we would end up with 15.6%. So these three are the respective return on equity figures for the three different economic scenarios. Now, as we showed before, they may also ask you the percentage change of the return on equity, with the normal economy being the base. So if the economy goes from normal to an expansion, what is the percentage change in return on equity? Well, we would take what? The new figure, 15.6, minus the old figure of 12 and divide that by 12. And when you do that, you get 0.3, or if we convert that to percentages, that would be a 30% increase. And then same thing with a recession. If we take the new figure of 7.2, subtract the base figure of 12, divide it by that base figure of 12, we end up getting negative 0.4, or a 40% decrease. And again, notice how even though we added these taxes of 30%, these figures are still in line with how much the earnings before interest and taxes is changing for the different economic scenarios. Because this 30% tax bracket is the same for all three scenarios, so really that numerator in both of the ratios is still changing by that same percentage. Even though it's a smaller figure, the percentage change between each of them is still the same. So the 30% increase, 40% decrease, even with taxes, is in line with the 30% increase, 40% decrease of that earnings before interest and taxes. Okay, so this is the return on equity ratio. We also have to figure out the earnings per share ratio. So what that is the net income over the number of shares. So we would take 12,600, the net income in a recession, and divide it by 20,000 shares. And that would give us what? 0.63. So the earnings per share is 63 cents if this firm is in a recession. Net income over the number of shares of 20,000. And if we follow that same pattern for a normal economy and an expansion, net income over number of shares, we get 1.05 as the earnings per share for a normal economy for this firm, and an earnings per share of 1.365 for an expansion. Now, earnings per share are usually in dollar terms, so usually they'll maybe round this to 1.37. I decided to just leave it as 3 decimal places. And then if you do the percentage change for the earnings per share, you'll get the same result that we've been getting. So this will be a 30% increase. Right, so this new figure minus the old figure all over this old figure, you'd get 0.3. And then on the recession side, if you take 0.63 minus 1.05 divided by 1.05, you would get negative 0.4, or a 40% decrease. And again, those percentage increases and decreases are in line with how much the earnings before interest and taxes is changing as well. So those are the return on equity and earnings per share figures for this unlevered firm. And we did 2 cases, if they're paying no taxes and if they are paying taxes. So now in the next video, in the second part to this lecture, what we're going to do is we're going to take this firm and we're going to lever it a bit. So we're going to issue some debt. We're going to use that debt to repurchase some shares to lower the equity. And then we're going to do the same process, and we're going to see how our return on equity and our earnings per share changes when a firm is levered.